Did you know that a recent study found nearly 60% of investors don't fully understand how taxes impact their investment returns? That's a staggering number. It's like working hard all year only to give away a big chunk of your earnings without realizing it. Investing in the stock market can be incredibly rewarding, offering the potential for significant growth and a brighter financial future. However, many investors overlook a crucial aspect of this journey: taxes. Taxes are an inevitable part of life, and they have a direct impact on your investment profits. Ignoring or misunderstanding tax implications can significantly erode your hard-earned gains. Just like you wouldn't ignore a leaky faucet in your home, you shouldn't turn a blind eye to taxes on your investments. It's time to take control and learn how to keep more of what you earn. Imagine this. You've carefully researched and selected a winning stock, watched it climb steadily, and decided to sell for a tidy profit. But wait, before you start celebrating, remember that Uncle Sam wants his share. Understanding the basics of investment taxes is not just about avoiding penalties. It's about making informed decisions that maximize your after-tax returns. When you're aware of the tax implications, you can strategize effectively. For example, you can optimize your holding periods to take advantage of lower tax rates on long-term capital gains. You can also explore tax-advantaged investment accounts to shelter your earnings from immediate taxation. Remember, knowledge is power, especially when it comes to your finances. By understanding how taxes affect your investments, you can make smarter choices and keep more of your hard-earned money working for you. Nobody likes opening their mailbox to find an unexpected bill, especially when it comes from the IRS. It's a moment that can cause immediate stress and anxiety, particularly for investors who might not be fully aware of the tax implications of their activities. Yet, many investors face this unpleasant surprise due to a lack of awareness about investment-related taxes. Understanding these taxes is crucial to avoid unexpected financial burdens. One common issue is underestimating capital gains taxes. Capital gains taxes apply when you sell an asset for more than you paid for it, and the rate can vary depending on how long you've held the asset. When you sell a stock for a profit, you're liable for taxes on that gain. Short-term capital gains from assets held for less than a year are taxed at a higher rate than long-term gains. Failing to account for these taxes can lead to a hefty tax bill come tax season. It's important to plan ahead and set aside funds to cover these potential liabilities. Another pitfall is neglecting to track wash sales. Wash sales occur when you sell a stock at a loss and then repurchase the same or a substantially similar stock within 30 days. If you sell a stock at a loss and then buy back the same or substantially similar stock within 30 days, you're subject to the wash sale rule. This rule disallows the loss deduction, which can complicate your tax situation. This rule disallows the loss deduction, potentially leading to a higher tax liability. Keeping detailed records and understanding the timing of your transactions can help you avoid this issue. By understanding these common tax issues and taking proactive steps to avoid them, you can save yourself from unnecessary financial stress and keep more of your investment profits. Consulting with a tax professional can also provide valuable guidance tailored to your specific situation. Let's demystify the jargon and break down the two main types of taxes that apply to stock investments: capital gains taxes and dividend taxes. Understanding these taxes is essential for any investor looking to maximize their returns and minimize their tax liabilities. Capital gains taxes are levied on the profits you make from selling your stocks. These taxes can significantly impact your overall investment returns, so it's important to be aware of how they work. The key here is the difference between your buying price, also known as the cost basis, and your selling price. This difference determines whether you have a capital gain or a capital loss. If you sell for more than you bought, you have a capital gain. This gain is subject to capital gains tax, which can vary depending on how long you held the investment. If you sell for less, you have a capital loss. While losses are never ideal, they can be used to offset gains and reduce your taxable income. Dividend taxes, on the other hand, apply to the payments you receive from companies you've invested in. These payments are a share of the company's profits distributed to shareholders. When a company distributes a portion of its profits to shareholders, you receive dividends. These dividends can be a great source of passive income. These dividends are considered taxable income. The tax rate on dividends can vary depending on whether they are qualified or non-qualified dividends. Understanding these two fundamental tax types is crucial for making informed investment decisions. By knowing how capital gains and dividend taxes work, you can better plan your investment strategy. Remember, each buy, sell, and dividend payment has tax implications. Keeping track of these transactions and understanding their tax consequences can help you avoid surprises at tax time. By factoring these into your strategy, you can optimize your returns and minimize your tax burden. Proper tax planning is an essential part of successful investing. Section 5. Keeping tabs. The importance of tracking your trades. Imagine trying to assemble a complex puzzle without all the pieces. That's what it's like trying to manage your investment taxes without proper records of your trades. Every time you buy or sell a stock, it's crucial to keep detailed records of the transaction. This includes the date of the trade, the number of shares bought or sold, the price per share, and any associated commissions or fees. Meticulous record-keeping might seem tedious, but it's your best defense against potential discrepancies with IRS records. It also simplifies the process of calculating your capital gains and losses when it's time to file your taxes. Thankfully, various online platforms and software programs can help you track your trades effortlessly. These tools can automatically import your transaction data, generate reports, and even calculate your tax liability. Section 6. Time is money. Short-term versus long-term capital gains. In the world of taxes, not all capital gains are created equal. The way you manage your investments can have a profound impact on your financial health. The duration for which you hold an asset before selling it makes a significant difference in your tax liability. This is a crucial aspect that every investor should understand. Short-term capital gains apply to assets held for 1 year or less. These gains are often the result of quick trades or short-term investments. These gains are taxed at your ordinary income tax rate, which can be significantly higher than the rates for long-term capital gains. This means you could end up paying a larger portion of your profits to taxes. Long-term capital gains, on the other hand, apply to assets held for more than 1 year. This encourages investors to think long-term and hold on to their investments. These gains are taxed at a lower rate, offering a substantial tax advantage. The difference in tax rates can be quite significant, making long-term investments more appealing. Holding an asset for just 1 day longer can make a big difference. That extra day can shift your gains from short-term to long-term, reducing your tax liability. Understanding the distinction between short-term and long-term capital gains is essential for optimizing your tax strategy. This knowledge can help you make more informed decisions about when to sell your assets. By holding your investments for the long haul, you can potentially reduce your tax burden and keep more of your profits. This strategy not only benefits your current financial situation, but also sets you up for future success. Section 7. A stitch in time. Proactive tax strategies for savvy investors. Don't wait until tax season to think about your investment taxes. Proactive tax planning is key to maximizing your returns and minimizing your tax liability. One effective strategy is tax loss harvesting. This involves selling losing investments to offset capital gains realized from winning investments. By strategically realizing losses, you can reduce your overall tax burden. Another powerful tool is tax-advantaged retirement accounts like 401(k)s and IRAs. These accounts allow your investments to grow tax-deferred, meaning you won't owe taxes on your earnings until you withdraw them in retirement. Remember, tax laws are complex and subject to change. It's crucial to stay informed about current regulations and seek guidance from a qualified financial advisor to develop a personalized tax strategy that aligns with your financial goals. Section 8. Your path to financial freedom. Seeking expert advice. Navigating the complexities of investment taxes can feel overwhelming, but you don't have to do it alone. Seeking guidance from a qualified financial advisor can provide invaluable peace of mind and help you make informed decisions. A financial advisor can help you develop a comprehensive tax plan tailored to your unique circumstances, goals, and risk tolerance. They can also keep you updated on changes in tax laws and regulations, ensuring you're always in compliance and maximizing your tax savings. Remember, just like you wouldn't hesitate to see a doctor when you're feeling unwell, don't hesitate to consult with a financial professional for your financial well-being. Section 9. Join the conversation. Share your tax-saving tips. Now that you've gained valuable insights into the world of investment taxes, it's time to share your thoughts and experiences. What are some of your top tax-saving tips for fellow investors? Have you encountered any unexpected tax issues? What strategies have you implemented to minimize your tax liability? Let's create a community of informed investors who empower each other to achieve financial freedom. Share your comments and questions below, and let's start a conversation about building a brighter financial future together. Remember, knowledge is power, and sharing that knowledge can make a world of difference.